Hi everyone, welcome back to my channel. Today I want to discuss why I prefer to trade micro ES, NQ, and RTY futures over trading SPY, QQQ, and IWM ETF options. This is something I get asked about a lot, so I decided to go through what I consider to be the biggest benefits of futures trading. Before we get started, if you would like to get a 10% discount for Trade Addicts, don't forget to use my referral link in the description. You'll also find referral links for TradingView and Top Step funded trader programs, which I'll get into in this video, that will give us both discounts. Lastly, if you enjoy this content, don't forget to like and subscribe to help me grow this channel. So with all that being said, let's get right into it. So the first reason that I think will appeal to most traders about futures trading versus trading options is the pattern day trader rule. So if you're not familiar with this, if you have a small account, meaning an account with less than $25,000 with it, and it is a margin account, which, for instance, if you're using a broker like Robinhood, margin accounts are the only option. Now, I prefer, when I'm trading options, I do use Interactive Brokers. They have a cash settled account option. I'm pretty sure TD Ameritrade, Thinkorswim does as well, and most brokers do, but a lot of people don't realize is that you are heavily constrained if you have a small account on margin, because if you take more than 3 day trades in a 5-day period, you will actually be penalized. And it's a pretty serious rule actually, and it prevents a lot of people from taking advantage of scalping or day trading, or these quick impulsive moves with options trading, because they're forced to hold longer than they necessarily want it to. Also, when you're futures trading versus stock trading, if you're trading stocks, if you try to short a stock, you actually have to pay a fee and interest for however long you're shorting it. Whereas in futures, when you go short, it's the same as going long. There's no penalty for doing so. And just to clarify my terminology, for an options trader, buying calls is the equivalent of going long, and buying shorts is the equivalent of going short, if you were to compare it to futures. So this, in my mind, is a really big benefit for those who don't have $25,000 that they are willing to start with. Another key benefit is that I really love: when you are trading futures, you have super precise entries and exits. So you can see in this screenshot here, when you decide to enter, like, so if you watch my volume price analysis series, you'll know what I'm talking about here. But when you start seeing these candle wicks form and high volume coming in at a volume gap, or in this case would be the value area high, and you want to take an entry right at that point, if I were doing this with options, I would have to consider things like Vega, Theta, the options Greeks, do some quick mental math potentially to determine, okay, is my limit order going to put me too high? Is it going to put me too low? Is it going to be exactly where I want? Whereas when you're trading futures, you can literally just click in the exact spot you want to put in your limit order, and you don't have to worry about the options Greeks impacting that and potentially missing that. You also don't have things like well, you do have some slippage, but spreads are a lot better. And I know when you're trading the main ETF, spreads aren't typically a problem anyway, but that does bring me into my next point, which is the extreme liquidity in the futures market. So if you look at the side-by-side charts, I have SPY on the left here, and I have micro ES on the right here. And when we're talking about point values, like they're pretty similar in terms of the profits you'd make based on where you take your entries. But if you notice, if you're looking at futures, and if you notice the last screenshot on the previous page, this is what volume profile looks like on futures, which is actually more precise because of the tick data that it's using. But on top of that, even the volume bars below are more pronounced. So when you're using a technique or a trading strategy that involves volume, which I highly recommend doing if you're not already doing so, can fit into any trading strategy, you'll notice that when you're trading futures, you get a lot more data. You see when it's a lot easier to spot these high volume candles versus mid-sized candles versus low volume candles, especially when we get into points of consolidation where volume is dropping off. You still get a lot of good insight and visibility into how the volume is relative to previous volume. And then, as I just mentioned, the spreads are extremely tight. So usually, wherever you enter, you're getting it within like a quarter to a half point. Whereas sometimes with certain options, I mean, not necessarily of SPY QQQ, but sometimes during times of low volume, low liquidity, you might have slippage that can impact your entry from like anywhere from $4 to in some cases with options it can be as bad as like $25 or $50. But and then also because and in particular, like if you're thinking of trading a ticker like XLE or OXY or XOM, you might want to consider crude oil futures instead, because if you're doing micro crude oil, you'll get similar point values, meaning you won't be risking an insane amount, but you'll also have that extra liquidity that you get with futures to not have to worry about getting a bad entry, even if it was at the place you wanted it, the contract value not being what you expected it to be. So that is a huge benefit. And I want to clarify that I do still trade options. I trade options a lot. I love trading options. But I'm particularly talking about the ETFs here. So if I'm trading if I'm going to be trading SPY, QQQ, or IWM, why I'd prefer to trade futures. Another huge benefit is funded trader programs that exist with futures trading. If you're not familiar with these, very interesting stuff. I have a referral link in my description that you can use for a discount that also helps me get a discount. Now, what's really nice about these programs is, and I recommend these for new traders all the time, it helped me when I was a new trader as well, but basically you go through a combine where you demonstrate to them that you can be a consistently profitable trader by following good risk reward management rules. There are no unfair rules. These are rules that you should probably be applying to your trading anyway. And what they do is, once you turn, say if you start with a $50,000 account, once you turn it into $53,000 twice with proper risk reward and position management, then they will at that point fund you. You no longer pay them a monthly fee at that point, and you keep 80% of the profits that you make. They keep 20%, and it's all on their dime, so they have all the risk. Now, when you're in that combine proving yourself, you do have to pay a monthly fee, and it varies depending on the account size, the amount of funding that you're trying to get. But the reason why I think that's a lot better than paper trading is because it introduces real emotion on your end without all the risk that you would normally have if you were doing it, say, with like a $2,000 account or something. Instead, you're risking at the most $165 a month or something like that. So that's one huge great thing about futures trading, especially for new traders. Another great thing for people in my position, now I also work a full-time job, so I have to always put that first, and there are times where I miss trading days, and so therefore, and also the hours I can trade during the day are pretty limited. So futures trading offers you can trade 23 hours a day, 6 days a week, so it's closed on Saturdays, and it's closed from 5 p.m. to 6 p.m. Eastern. But on top of that, you see some really good volume come in on these main indices like ES and NQ in the after hours during the European Open and the Asia Open. And those are some great times to play the markets if you're busy during the day and you can't trade during normal trading hours. Another nice thing is, especially compared to a lot of other brokers I see out there, I don't have this problem with interactive brokers. Then, of course, brokers like Robinhood and Webull are free. However, they're not technically free because they participate in something called payment for order flow, which means they're selling all your trade info to the market makers, who in turn can likely use it against you, and you're not necessarily guaranteed to get the best price on your entries. You don't have that problem with futures. You have low commission costs. Data fees are pretty low. You can see my data fees are $9 a month. Now you can get plans that also help make the commission fees even cheaper, especially if you're a fast scalper and you don't want to pay that 80 cents every time you enter and exit on micro futures per contract. You can get a plan that's geared towards that. So, and that leads me to my next point here is that futures is fantastic for scalping. So essentially, because ES has 10 times the point value of SPY, so if SPY's at 450, or actually in modern times SPY's at 380, then ES is going to be around 3,800. And basically, and then NQ is actually 41 times out of QQQ, and RTY is 10 times out of IWM. So you're trading the same exact charts and you're seeing the same exact stuff, but for every $1 move on SPY, you're actually looking at a 10-point move on ES or micro ES. Also, when you enter in, one thing that's interesting is when you're trading options, normally you're buying a call or a put, and you're paying somewhere around $100 to $200 for that call or put up front. When you enter in on futures, you enter in on margin, and you actually, besides your commission fee, that value starts at zero. And essentially what happens is it will run up. So if it starts move, so say you short micro ES, which is $5 per point, and it starts dropping, you make $5 per point per micro contract. In theory, limitless essentially, until you choose to exit that position. Now the downside is that if it goes against you, it can also go unlimited against you, and that's why it's very important to exercise proper risk management and position management, which you should 100% be doing, regardless of what you're trading, whether it's stocks, crypto, options, or futures. You should always know in advance what your profit target is and what your stop loss is, and I'll do another video getting into that further. Now, one thing I found myself doing a lot, or I still do a lot, whenever I'm trading options, I always watch the main ETF. So I was always watching SPY and QQQ, and actually I would end up watching futures when I had futures data enabled, because futures are so tightly correlated with all of their underlying holdings in the market in general that I wanted to know if I was trading a stock that was going against the overall market, and therefore I'd be more cautious or maybe even scratch that trade. For instance, I don't like trading a stock like AMD if it's doing the opposite of what the NASDAQ is doing. So essentially, since you're already typically watching futures to get that market awareness on the options that you're trading, it makes a lot of sense to trade those futures. You get the best insight there, so you might as well trade them. And then also, if you love selling options, futures are a great way to hedge those options. That's how the market makers do it. I don't want to get too deep into that because it's a super complex topic, but essentially, if you're out there selling calls and puts to people to make money on options premium, you can actually hedge using futures by going long or short, and there's calculations you can do. Obviously, if you're a market maker, those calculations get insanely complex, but it is a good hedging mechanism. And then futures offer extremely high leverage. So essentially what I mean by that is, if you have a futures account and you're trading micro futures, so micro ES is $5 a point, micro NASDAQ is $2 a point, micro Russell, which is basically IWM, is also $5 a point. And when you're trading those, you actually only, since it's margin based, you actually only need $5 or $55 per position that you're taking. So if I want to short 5 micro contracts on micro ES, I only need $55 per contract. Now that's like the bare minimum, so obviously you should have more than that, because if you get the trade wrong, then you can no longer trade. But that's a much easier barrier to entry than what would be with options, especially during times of high volatility when the VIX is very high. We can see options prices, especially put options, really skyrocket, and sometimes to get into those plays, you're going to need anywhere from $200 to $400 per contract in order to enter the play, whereas your minimum with futures is $55. And the nice thing is, like, yes, you can buy really cheap, out of the money, super close expiration, 0 DTE contracts when you're trading SPY and QQQ, but the downside of doing that is now your delta is lower. It also you're also impacted by theta and vega. There's all these Greeks impacting the profit that you're trying to make there, and you hurt your potential profit by going too far out of the money or too short of an expiration just to make that contract cheaper. Whereas with futures, no matter what, it's always going to be the same margin requirement and the same point value that you're going to win. You don't have to worry about Greeks taking away from that profit. And then lastly, when you start making consistent gains, this is a huge benefit. You get better tax benefits with futures. So you can see here it's a 60-40 rule, means 60% of net gains on futures trading is treated like long-term capital gains, and 40% is treated as short-term capital gains. So most often with futures, there's very few long-term futures holders out there, or futures traders out there, and there's a lot of reasons for that, especially because the contracts themselves work in 3-month increments. So you're typically not holding your positions very long. It's rare to really swing futures positions for retail traders longer than like a week. Most people I know that trade futures are day traders and scalpers, and instead of having 100% of that being taxed as short-term capital gains, no matter how short of a time you hold it, only 40% of that is taxed at short-term capital gains. So when you're day trading, this makes futures really the best choice. So again, I just want to state before closing out this video that I do still trade options. I love trading options, but I only focus on options when I'm trading underlying tickers like, DKNG or AMD or NVIDIA or XOM or whatever it might be. When it comes to the main ETFs like SPY, QQQ, and IWM, or even some sector ETFs like XLE, I always prefer to trade the futures version of that instead because of all of the benefits that I just mentioned. So anyway, if you're interested in trading futures and you're interested in becoming a funded trader, please check the links in the description because you can get a discount for doing so if you're interested in that whole funded trader concept, which I find is fantastic. My futures account I do Top Step with. I don't really use my own personal futures account ever. I just use my funded futures account. And then with options trading, I prefer to use Interactive Brokers. And I'll probably leave a referral link in the description there as well if you're not familiar with them. So anyway, let me know if you have any questions, and I hope this was helpful.